Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 17th of July, 2019, and we're looking at economic figures announced yesterday, plus our view on where the US dollar is heading. In recent months, we have commented frequently on the US dollar and where we believe its value is heading. We have maintained for many years, in fact, that the dollar will either gain in strength or at worst maintain its strength. This has frequently been contrary to the views of many other so-called experts, and certainly compared with those we call pumpers, who either claim the dollar is likely to weaken significantly or, in the latter case, collapse altogether. The recent comments made by the Fed Chairman Jerome Powell at his two congressional testimonies last week suggest that the Fed will in fact be lowering interest rates on the 31st of July. Our view is that the Fed should not do this, as, quite frankly, the US is looking at relatively stable growth rates of between 2 to 3%, has inflation oscillating within a tight band of 1.5 to 2.1%, and has a relatively tight job market with weak wage inflation. Under normal circumstances, when faced with those statistics, central banks generally hold rates and wait and see. However, we are not operating under normal circumstances. For example, there is a major trade tariff war going on between the US and China, and no one really knows how quickly that will be resolved. Many parts of the world's economy suggest a fall in growth, and in some circumstances into recession. And the impact on the US so far has been limited, but could indeed intensify. No one really knows what the outcome of a hard Brexit will look like. However, the chances of that occurring is now very high indeed. Other central banks have either adopted a more accommodative approach towards a looser monetary policy or have indicated their willingness to do so in order to help bolster their respective economies. And under normal circumstances, every 7 to 10 years, an economic correction and/or recession occurs, resulting in house price falls and major stock market corrections. And to date, apart from one or two scares, this has not occurred, and economic pundits are screaming that this must happen and will happen quite soon. In addition to these abnormal circumstances, the markets have also factored in at least 1 and up to 3 interest rate cuts, depending upon whom you ask, over the next 6 to 9 months or so. So, the Fed, which does not like to surprise markets, are likely to lower rates this month, partly for the reasons mentioned above, and partly for insurance reasons, in case worse economic figures come down the pipe. And also, we suspect, if it's just a 0.25% reduction, it will have little effect physically, but quite a large effect psychologically, especially on business sentiment, which has for many months been far more negative than consumer sentiment. Interestingly, many traders, economists, and economic commentators have been mooting that the Fed could in fact reduce rates by 0.5% in July, but we shall explain why we do not believe that will happen. The first is that the economic data published so far does not support a 0.5% cut, and as we have already mentioned, we don't believe it really supports a 0.25% cut at this stage. A 0.5% reduction may actually frighten markets, as it suggests that the Fed is aware of more acute financial problems ahead than they are currently admitting to. Smaller, but possibly more frequent cuts give the Fed a little more control over both the narrative and expectations, and will enable it to spread out these reductions over longer periods of time, which we know to be its preference. To further support our view, a report from the Commerce Department yesterday showed that US retail sales increased more than expected in June, pointing to strong consumer spending, which could help to blunt some of the drag on the economy from weak business investment. Retail sales increased 0.4% last month as households increased purchases of motor vehicles and a variety of other goods, including furniture and building materials. Admittedly, the data for May was revised slightly down to show retail sales gaining 0.4% instead of rising 0.5% as previously reported. Economists polled by Reuters had forecast retail sales edging up just 0.1% in June, and so this 0.3% divergence between expectations and actual results will certainly suggest to the Fed that a 0.5% cut may be too large too soon, especially as strong jobs growth resurrected last month, and we also saw a small rise in underlying inflation. Now, the effect of these positive figures buoyed the dollar against a basket of currencies, while US Treasury prices fell. Amusingly, some economists are now taking our view and stating that with stronger consumer spending and job growth regaining momentum, the Fed should not cut rates at the end of this month. But that said, we are pretty certain Jerome Powell will not wish to upset markets by surprising them. But as already mentioned, we shall see a 0.25% cut rather than a 0.5% cut. Now, what effect is all of this having on the US dollar? Well, in recent weeks, we've seen the dollar fall slightly compared with a number of its main trading partners. But as we prepared this podcast, the dollar is holding up pretty well at 97. In fact, the dollar index is currently 97.32. And this is the area we would like listeners and subscribers and members to pay close attention to. We have a situation in the United Kingdom where interest rates stand at 0.75%, in other words, 0.75%. And we have a situation in Europe where interest rates are 0%. And both of these economic areas are facing major growth issues. The Fed's funds rate is currently 2.25 to 2.5%, so a small reduction of just 0.25% is still keeping US rates well above those of Europe and the United Kingdom. With a hard Brexit likely, and the Governor of the Bank of England stating that if that does occur, the UK will have to reduce rates further, and the retiring head of the ECB, the European Central Bank, Mario Draghi, stating that he will do anything necessary to keep the European economy out of recession, and if that means buying more bonds or what we understand as QE or quantitative easing, then he will do so, and so will his successor Christine Lagarde. With these statements having been made and these circumstances prevailing, one has to ask the question, why would any money manager looking for a relatively safe return on his or her money not consider the US dollar the better investment, certainly when compared with euro or sterling? Now, before anyone mentions the yuan, let's just park that one there. As China's central bank has already mentioned, and in a number of instances instigated, measures all of which serve to reduce the value of the yuan in order to assist its exports. So, with a 0.25% rate cut already baked in for the 31st of July, when it does occur, traders will be more interested in Powell's comments afterwards than the cut itself. We suggest the US dollar will maintain its strength, if not increase it. And this will only reverse if the cut is 0.5%, or Powell indicates that another cut will be virtually imminent, both of which we doubt will be the case. The effect on gold and silver, which stands at $1,402 and $15.62 respectively, will be muted, and these precious metals will have to look at other reasons, such as geopolitics, or perhaps a slight correction in the gold-to-silver ratio, to impact their price further. What do you think? Do you agree with us or disagree? Either way, do please state your reasons. Now, before ending this video, we would like to draw members' attention to some merchandise we have placed on the website. Bronze and silver members will receive a 10% and 20% discount respectively. And if wearing or promoting our brand or having a brand memento is something you would like to do, then please by all means head off to illuminatisilver.com. All of the prices quoted include postage rates, and please revisit frequently, as there will be a number of new designs and items added very soon and regularly. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.